Away from that, Kenyan investors with government bonds are encouraged to retain their investments or purchase more to optimize their returns. Paul Njoki, head of Affluent Banking at Standard Chartered, emphasizes that the present interest rates is highly appealing, though the opportunity is diminishing as central banks globally consider lowering rates. Ben Mike Wekesa now reports.
For the second half of the year 2024, high inflation characterized the first half of the year, leading central banks worldwide to tighten their monetary policy. The high interest rates made government bonds attractive. However, as central banks prepare for monetary easing, bond investors are advised to hold on for maximum returns. According to Standard Chartered Bank, investors should consider equities, bonds, and gold markets. Those holding cash are encouraged to start releasing it as the horizon of higher earnings is ending.
Allocate a part of your investment into global equities, a portion of that, right? And if you want to go sub-segment of global equity, I'll say US, okay? Okay, so that's number one. The second thing I will say, have a proportion of your investment that is in the bond market. Now, that you can slice to local bonds, or you can say, US dollar bonds as well. And if you still want to go a slightly, dimension, you can say emerging market US dollar bonds.
Kenyan investors are moving away from real estate investments as their growth and returns decline, with yields slowing to between 3 to 5% and middle-tier returns at 9 to 10%. This shift is driving investors towards other asset classes like money market funds, which offer better returns due to their bond market involvement.
Additionally, real estate has provided a fantastic opportunity for Kenyans to invest. I think time has come that we need to look at that asset category in the light of what other alternatives are there, and pound for pound check whether actually we are making a return. But the money market funds are doing very well. Of course, the underlying assets or securities in the money market funds are bonds and bank deposits. So then you can actually translate and see if the bonds are giving a good rate, TBs are giving a good rate, you go to a bank deposit, you get a good rate. Then it goes without saying that that gain is being, in a money market, is transferring as well to the investor.
However, political transitions worldwide present significant risks for investors. With central banks expected to cut rates in the second half of the year, investors should consider bonds, equities, and gold as viable investments. Reporting for the Tandao News Outlook, I am Ben Mike Wekesa.